Welcome, everyone. I think we've got everybody dialing in, and we will therefore kick it off just 1 minute past the hour. So I'm Breanne Dougherty, head of thematic strategy here with Bloomberg Intelligence, and it was an absolute honor to get reached out to by Evenco this month in order to help bring live their 17th volume of Trend Watch, this time obviously in collaboration with Bloomberg Intelligence. If you follow Evenco on LinkedIn, you would have seen that they've published some tremendous content over the last month, really highlighting and showcasing female voices. So actually today, it's a particular privilege to be hosting a panel of all women in the month of March. Evenco's international mission is really to unite top fund selectors and global managers to drive forward-thinking investment strategies via fund forums and analytics, which is precisely what we will be doing today. And as I said, I am joined by three exceptional voices, and I can't wait to get the conversation started. So those voices being Shanti Kelemen, Chief Investment Officer at M&G Wealth, Katy Forbes, Chief Investment Officer at North Capital, and Sylvia Jablonski, Kampaktsis, CEO and CIO of Defiance ETFs. So I'm just going to kick it off right away and let you each intro yourselves a little bit and the organizations that you work with. So Katy, I can start with you.
Sure, thanks, Bree. So as you said, I'm Chief Investment Officer at North Capital. We are a private independent wealth manager based in Edinburgh in Scotland. Prior to joining here, I spent over 20 years in macro investing and primarily fixed income and multi-asset, mainly at Standard Life Investments. I'll leave it there.
Great. Shanti?
Shanti, I'm the Chief Investment Officer at M&G Wealth. I run the model portfolio service for M&G Wealth, and then kind of sitting across from me, aside from me, we also have our big insurance fund, Proof Fund, and then we also have the whole M&G investment single strategies. So that's kind of the big picture of M&G.
Great.
Hi, I'm Sylvia. I'm the CEO and CIO of Defiance ETFs. So we're essentially an ETF company. We have products that sit in the spaces of AI, quantum computing, some of the disruptive, innovative technology themes, as well as enhanced income product ETFs. And prior to starting Defiance with my co-founder, my background is essentially Delta One equity derivatives trading.
Fantastic. Katy, it's nice actually. We don't often get somebody in from Edinburgh. Early in my career, I worked for a Scottish-based company and spent some time in Edinburgh, which feels like a little bit of a callback career-wise to have somebody from Edinburgh actually on the panel today. So let's get things started. Over the conversations I've had with different CIOs of late, I feel like one place to start is probably, I just want to gauge everybody's temperature. Let's do a little bit of triage here as to how we're sitting. Obviously, we're coming to the end of Q1 of 2024. At the end of 2023, it felt like there was particularly high flurry of conversations around, divergent outlooks for what was going to happen next in the market. So I think a good thing for us to start at is just really trying to figure out where everybody's temperature is right now. So I'm going to do some rapid fire questions. Doesn't have to be one word, but few word answers ideally in order to kind of keep the pace moving. I am going to start with your current temperature. So growth versus defensive. How are you positioned right now? Or what do you, from an outlook for 2024? Sylvia?
Growth.
Growth. Shanti?
Yeah, same, growth.
Katy?
I like growth, but I think there's good opportunities in defensive too. So I'll hedge my bets. Yeah.
I like that. Your relative temperature, has it changed any in the last quarter? Did you move into 2024 with a different vibe and now it's moved? Katy?
We've leaned more into growth in recent months, actually, largely due to the specific picks within growth as well. So yeah.
Fantastic. Shanti?
Mildly more positive. I think believe more that the economy can handle interest rates where they are.
Excellent. And Sylvia?
Agree on that point. I started to become bullish towards the end of 2022, and I have become consistently more bullish for short-term stock and trading opportunities.
Not that I don't love the other side of the conversation, but I have to say it's always there's something that's a little bit refreshing to hear the word bullish come out, at least across all three voices there. Anything that you are watching closely that would make you change your current, what sounds to be generally like increasingly bullish vibe that you've got going? Shanti?
For me, it's company profits, company earnings. I feel like it's kind of the only audited thing we can trust these days, given all the issues with data and GDP revisions and unemployment figures based on two people replying to a survey. So that's what I'm focusing on more and more.
Sylvia?
Yeah, like Shanti's point on that, I agree with all of that. I think any kind of outliers could be things like Fed changing course, geopolitics. We have two wars going on, and these things have kind of come into play into the markets over the last couple of years, where they really haven't been issues for the decade before that. So I think kind of the unknown variables in geopolitics and Fed policy.
Okay, great. And Katy?
Yeah, I mean, corporate earnings, but also very much the central banks and their stance. And obviously, we saw from the Fed last night, still super supportive.
Perfect. All right, this one, it might be a harder one to answer, but I'm going to throw it out there anyways. What has you most excited from an investment? I mean, also tell me the next movie that you're waiting to watch if you want to, mix that in if you'd like. But from an investment standpoint, what has you most excited as you look to the near term? Sylvia? Or Shanti, go ahead. Yeah.
I'll say I stopped watching movies like 3 years ago.
I did like holdovers.
And the movie industry has never recovered. But no, I think for me, it's that valuations kind of outside of the US, particularly some of Asia and Japan, are still really reasonable. And there's a lot of room for growth. So I think that's one of the most probably exciting opportunity we see. And it's just not in the press or talked about as much as it should be, I think.
Okay. Sylvia?
Same on the movies. I'm just all in on childcare. So Kelemen is probably the last thing that I've seen, and I'm not a huge fan. Although it's amazing what that company has done, but that's a different point, I suppose. I'm just most excited about. I think and Bree, you and I talked about this on the phone. Right? We've been talking about themes and kind of like thematic products and things like that for years. And I think that now some of the actual like words that we use like disruption, innovation, and technology are coming to light. So I'm most excited about, AI, that the whole tech story, supercomputing, quantum computing, and like where that whole industry is going to go. Not just, the chat GPT robots or like the cool things we see, but the actual transformation of economies because of AI.
Excellent. And Katy?
Yeah, I mean, broadening equity participation, I think, is the next sort of big move. We've obviously seen some but quite narrow leadership in some of the moves so far, but I think there's a lot of reason to expect broadening, whether that's other regions or just other sectors. But I think there's a lot of things to get excited about.
Okay, I'm going to dig in on that. I think actually what you said there, Katy, is probably a good place for us to start on digging in a little bit into that topic around that broadening, because what I'm hearing, Shanti, Sylvia, everybody's kind of, they've got some spots that they're really looking, which to me implies, again, this idea that you can, if you look closely, there might be some spots that you're not so keen on, but there's definitely some areas to look. So when we think about that all points to it, it's a narrative that's been around for a while. I think heading into 2024 is this active versus passive. So I'm interested to hear your stance on just one, how much of a moment this might be for active, and kind of more importantly, is it a flash in the pan moment for active, or does this mean that there's opportunity for active maybe for a little bit of a regime shift from the passive dominance of late? Shanti?
We haven't really changed our views on where active and passive makes sense. I think there's markets where you don't have as good of information, places like small caps and EM where we do a lot more active. And I think fixed income, it's also genuinely easier because the market cap weighting approach just doesn't work as well in fixed income. You don't necessarily want the most exposure to the companies with the most debt. So I think a lot of those views haven't changed. I think it shifts to a lot of people are starting to, even though they're using passive funds, you still do active asset allocation. And I think that's where you're going to see people, even if they are sort of passive, they're going to try to add value that way, because we should have some more dispersion with interest rates, more dispersion with equity markets and sectors, and that gives more opportunity at that level. I think we're still getting thrown around a lot by macro news with interest rates and geopolitics, which means I think until we get a fairly calm patch, you're not going to see as much intersector dispersion potentially.
And do you think that right now people have been too boisterous in the expectations on some of those rate reversals, that like everybody's a little too confident that there's going to be many and soon?
I think so. And you see, we all were too confident in November because a lot of that has already been unwound. But I think you can easily construct a scenario where there's no rate cuts in the US this year, because if economic growth stays high, unemployment stays low, inflation stays at, 3.5%, 4%, why would you need to cut rates? And I think there's also a risk that if you don't do it quite soon, in the US, they're not going to probably want to do it when the presidential race is in full swing. And so then you probably don't get anything maybe until December. You could have some similar impacts in the UK where we'll have an election potentially here. So I think there's probably a little bit more to come out of expectations on the rate cuts.
Sylvia, from your position, I mean, naturally living in the ETF world, so much of that has, passive has given rise to a huge portion of the ETF landscape. How, from your point, CEO of an ETF provider, how has this potential shift towards active or appetite for active impacted what you guys are doing?
Yeah, so it's changed so much. I would say that, I've spent like a good decade, almost decade and a half now in ETFs. And so maybe like 5 or 6 years ago, when I worked at the other ETF provider that I was, kind of working with, ETF companies were really hesitant to launch active, because at that point, it just looked like all of the flows were going to passive. The feedback that we would get from wealth advisors is that, passive is cheap. They're the active managers. They will actively manage the passive funds. So they just want them to be cheap and easy and transparent. And it was really hard to sell an active fund. And so, a lot of ETF providers anyway shied away from them. Obviously, there were a lot of, kind of successful active funds out there and have been, kind of forever, but just in terms of just like mass adoption. And now more active funds are being launched on a daily basis. And I think that like part of that is because ETFs have evolved, right? So instead of just the straight market cap or, like every sector theme basic ETF allocation that you're looking for is probably already out there. But now you have these products that do different things. So some of them have leverage embedded. Some of them have, put right strategies on them. Some of them we were talking about, kind of AI, quantum computing, things like this. A lot of the companies that are, the picks that advisors want access to are just coming out into the market, in near time, like a super microcomputer story, for example. Like that's not something that sits in a lot of thematic ETFs, and it probably should, right? And so when you have an active fund as a provider, it just allows you to keep up with the times, keep up with what people want in those, specific types of themes and asset classes and things like that. And so for us, like we were straight passive, we were index, benchmarking, cheap, transparent, we still are, even with our active funds, but we've now figured out that like, in order to compete and just, in terms of like what investors want, we have to create funds that are a little bit more creative, a little bit more actively managed to really, deliver on performance and theme. And so for us, active has been of, kind of highest importance and highest levels of adoption. And I said this to you on the phone too, Bree, when we did the pre-panel call, like we have products out there that like we have a 5G ETF, right? And when we launched that ETF, it did quite well, and particularly during COVID, because everything, you turn on the TV, all you heard about was 5G, lower latency. We all need to connect to the world. And that ETF grew to, almost $1 billion in AUM overnight. And then, kind of half of that fell out because now people are after 6G, right? And so we didn't have an active fund. And so in order to fix that, it took us a few months and conversations with regulators and working with an index provider to like reset the fund to reflect what people want today, and had that been an active fund, we could have just done that, right? So there are some benefits, I think, in certain areas.
And I think you raise a valid, all of it valid, but a really interesting point in this about, and this is something I find particularly interesting, or I think interesting about 2024 is, let's be honest, like the traditional construct or, the data of 10 years ago, is it relevant today? I mean, the market has changed so much. We've got different participants, retail investors, throw a little bit of wrench into the plans as to how things move. Katy, you mentioned specifically like the broadening out that right now, let's be honest. I mean, you nailed it at the beginning there, that the performance, the strong performance, has been pretty concentrated into a few. And if we see that broadening out, that really does change the game with respect to where the markets could go in the near term. When you're looking towards that broadening, I know Shanti, you mentioned EM. We're going to get to that for sure, because that's something that's crazy interesting to me on where you're looking there. But Katy, I'm interested from your perspective. Where do you think that broadening might happen first? Is it tech related, kind of on the back of Sylvia there around the AI stuff, or is it a little bit broader even than that?
So within sectors, sure, and then obviously, I don't think AI and tech is a bubble as such, because the earnings are so good. But there's related areas which can also do well. But thinking on a regional perspective, we had, say, last year emerging markets really trailed, but even within that there was quite a lot of interesting, spread between what did well, what did badly, and obviously China did poorly. But I think what interesting stuff you're seeing at the moment is, sort of global export growth picking up, for example. And I think through last year, it was all about the US economy surprising to the upside, and the US economy still looks strong. But we're seeing a pickup in some of the data in Europe and the UK, in global exports in Korea and Taiwan, Japan, parts of Japan as well. And that's a bit of a different story. We would really like Japan for different reasons. But you're seeing a broadening in the data, I think, which is quite important to thinking about a broadening in participation. So yeah, we're quite excited about that coming through.
Can you dig a little bit more on Japan? I'll be honest, that's one I don't hear as much about. So
Japan's a really interesting story. We've liked it for a while. So there's a lot of corporate governance reform going on. So the Tokyo Stock Exchange sort of naming and shaming companies with price to books below 1, and they don't want that. There's tax incentives for the individuals. They've recently gone through the previous all-time high, which was, goodness, back in the late 80s, I think. So all that's kind of bodes well. Those kind of psychological barriers taken away, and then obviously over the last week, there's much anticipation about, oh my God, the Bank of Japan's going to move away from negative interest rates, and people fearing that would, be a big, push against the equity market. But actually, in the end, yes, they moved away from negative interest rates, but they did it so gently and they did it so dovishly that, we're seeing that the stock market's still able to move upwards with that. So, I think there's just so much different drivers going on in Japan, whether it's, looking at the corporate governance reform, obviously the super accommodative monetary policy. I mean, they're at 0% now versus obviously the Fed and so on above 5%. So that's a huge driver. And then we think that you can get broadening sort of investor participation domestically in Japan as well, because of various tax incentives. So there's so much going on. I think there's a lot to like about Japan.
And on the EM side, maybe this is to both you and Shanti possibly. On the EM side, are we talking mostly Asia EM, or are you talking also other parts of EM?
Yeah, so EM's an area where we're increasingly using active managers. So from a personal perspective, I'd say, well, there's lots of areas to like about Asia, ex-China, but of course Chinese equities have a valuation, that's quite exciting now. But personally, I might leave that to the active managers to get involved in which specific companies, are of interest. But and India's got great demographics, obviously, and it's sort of a go-to hub for companies that want services and software and so on. But Latin America is quite exciting as well. Mexico, for example, the whole friend-shoring theme with the US. I think that's quite an exciting area too. So, but there's so much breadth, and that's why I think there's an abundance of opportunities for active managers there.
Yeah. I think Asia, people underappreciate the technology story element of it, because you have the Taiwan, South Korea, even Japan as well. There's a lot of semiconductor exposure there, which people underappreciate. Then you have the elements of with, foreign direct investment in China has plummeted largely due to what the US done, but that's pushed a lot of investment into other countries. And so you're seeing those trade flows kind of being rerouted, rather than China to US, it's China to Vietnam to US. So that's benefited them. And then a lot of people saying, well, the political risk around China, I don't want to go there. I'll invest in India, I'll invest in these other places. So that's been really positive. I think while China is incredibly cheap, I think it's hard to see, it's hard to see the current political environment changing. And the US is basically doesn't want any technology going there or any capital going there. And they've been quite successful in stopping that. Without that changing, which politically it doesn't seem like it will, it seems unlikely you'll really see a secular boom there. And then the other issue is shareholder rights. Can we actually be confident if we invest there, will we be treated fairly as shareholders? Are the things that are being spun off on the stock exchange only the things that the party insiders don't want? So you're only kind of getting the crap that's sold off on public markets, and the valuable companies will stay. On the positive side, you probably have all the battery technology, seeing what they can do with electric vehicles. So we do have some exposure to China, but I think it's something where we'll, maybe see it bounce from a very low valuation, but it's hard to see a situation like India where we think is more of a long-term secular growth story happening there.
And so, you mentioned, Katy, you mentioned LATAM, and Sylvia, by all means, feel free to chime in here on how you guys might be looking at regions. Obviously a lot of the ETFs, might be US centric, but keen to hear your perspective on that as well. So LATAM and the friend shorting, that has to be driving some particular interest. Is it in the EM Asia? I think I'm hearing from Shanti a lot of technology, kind of driving those trends there, and technology trends. Whereas in LATAM, I'm going to guess it's more natural resource and materials that would be gravitating towards that environment.
Yeah, historically it's more there. Mexico also has a lot of manufacturing. Yeah. I think going outside of Asia, probably more interested on the bond side in like Latin America and the Middle East, because that's where you have things like interest rates probably coming down in Brazil or Mexico. And I think the other really interesting thing about emerging market bonds is the credit quality of that asset class has increased dramatically, mainly from all the Gulf nations in the Middle East joining it. So, all the Saudi bonds, the Qatar bonds, the UAE bonds, those are all very highly rated. So the percentage of bonds in EM, in the emerging market bonds, is actually a much higher credit rating than it used to be. So people often look at it and go, oh, like the credit spreads are tight, but they're tight because the credit rating is so much better. So I think for me, it's probably Asia for the equity side, but go out further, the whole world on when you get to the bond side. And there's, a lot of opportunities because people forget that inflation in emerging markets is dramatically lower than it was 2 decades ago. We aren't having these systematic balance of payments issues and like currency runs anywhere near as much as we used to. So it's really, we talk about inflation in the West. Inflation is actually under a lot better control in emerging markets than it used to be, on balance.
Excellent. Anybody else on the views on some of these more distinct? Middle East always gets me interested, because we've seen a huge uptick in interest. I can say specifically from clients, wanting to have that conversation more and more. And I also remember in 2023 it was a big story, specifically around private markets and VCs, for instance. So interested to hear, Sylvia or Katy, anything you might have that you're particularly looking at, or maybe not even putting money necessarily yet, but watching closely with respect to Middle East and what they've got going.
Not so much Middle East on our side, although our most recent foray into international markets, we launched a Israel bond fund.
Okay.
It's called the High ETF, and kind of pre breakout of the war, just circling it back to tech and equities, and I do think that is the long-term Asia story, with middle class growing population there and being consumers of tech and semiconductors and things like that. Israel's a very similar story, right? Very entrepreneurial type of market. some of the top tech and top advancements in innovation and AI and just about everything. I think, you know, a lot of investors in the US forget does come from that region. And so, you know, we created a fund that gives essentially access to bonds in that market. And I think that they're, you know, you're talking about these 6 to 8% yielding products. They have stable, even, you know, regardless of what's going on with the war, they have, you know, one of the best, you know, debt ratios. They have to essentially, you know, pull down the appreciation of their currency. They have this entrepreneurial spirit, this, you know, kind of like massive growth within their economy. And so there has been this like push and interest from investors to get access to those types of markets. And it's actually one of the countries that has kind of enough issuers that you can put into an ETF to get exposure to that market. So we do touch that. And then in terms of we focus a lot on quantum supercomputing. We think that's kind of like the next Gen AI, right? Like that's, you need supercomputers for AI to work and all that. And so that's how we think about it. And there's so much interest in Korea, Japan, China, and India in that fund, but also just in that topic. And again, you know, I think it's already been mentioned, but, you know, you just have this massive growth story happening, particularly in India. Japan has kind of turned around. They're almost what China was before these pullbacks. And so, you know, lots of demand for tech there and growth opportunities for increasing breadth and investment diversity opportunity.
I'm going to then go to the elephant in the room, which will be AI. But I will say that it's interesting about Japan, something that we've noticed ourselves. So in the thematic strategy team here in BI, obviously we've got 31 themes across, you know, a strong breadth of the market there. The dominance of Japan in robotics, right, and the role of that in a lot of what's happening. That is very much the theme where we see Japan, you know, as a leader in it. And so it is particularly interesting given the rise of AI, which brings me, I think, to what could be a really interesting perspective to hear from each of you is just specifically around this AI. I mean, we talk about there's obviously been some concentrated performance in some strong AI names or names that can obviously have high exposure to AI. Where next? Right? So where does this AI tailwind extend next? Or even if it's not next, kind of within the next few years, I'm interested to hear, you know, how you're trying to stay ahead of the game of what this AI era means. Shanti?
Yeah, sure. So I think, well, one, for all these companies to be doing all this, the tech companies to be doing great things with the AI, at some point it's got to start benefiting other sectors, right? Because they need other sectors to buy it for it to be useful to keep the sales up. So, you know, it's things like, you know, as companies adopt Microsoft Copilot, do you see those other companies get more efficient? And I think there's, you know, there's probably the potential to see some of the companies, you know, particularly in financial services where they have lots of data, or healthcare, become a bit more efficient and productive using some of those tools. I think probably the big risk maybe for some of these companies that are making a lot of money in AI is, you know, one, it's the competition. You know, everyone is nipping at the heels. You look at, you know, even with NVIDIA, you know, it's basically giving all its chips to its biggest potential competitors or to the other big tech firms who can turn around and try to design them themselves. And there's a huge risk that while you maybe you have really good earnings for a while, once you go X growth, you get severely punished by the market, you know. And it's that thing of maybe we can do a few years of these excess earnings, but when it normalizes a bit, do you get a huge drawdown once investors take out that forward projection of 50% growth? So I think we'll probably run a bit further with the momentum. But I think you'll have to see it start helping other sectors. And then I think competition, as it always does, will level things to some degree over time.
When you think of, it's interesting, it was even, I guess it was early last year. I want to say even before it was too much of a, I want to say it was late 2022, the first time I was hearing these conversations with respect, specifically with respect to themes, like why themes matter. And there was a conversation I had with an investor around this idea of being a thematic tourist versus a purist. And he refers to himself as a tourist in the sense that he likes themes, but the themes specifically were the ones that were about operational adaptation, right? And so these were the themes that were the ones that pulled him in on occasion to thematics in order to tilt his portfolios and things like that. And then AI came and you're like, oh, this is the quintessential, right? So when you think about the fact that AI can really help so many sectors, companies, in improving some efficiencies. I'm interested, Shanti, if you've got any perspective on where you think that's going to start coming through on the earnings first, if there's some sectors where you're going to start to see the AI knock-on efficiency effect.
Yeah. So I think the biggest stuff we're already seeing examples in the market is people have customer service units. So I think Klarna said they were able to improve accuracy and efficiency of their customer service dramatically by having an AI, chat respond to customers rather than actual people doing it. So you reduce costs, you improve outcomes, you win. I think the other big one is some of the stuff around drug discovery and speeding that up. So some of the pharmaceutical can reduce R&D. And I think the other huge one is marketing functions, and media and content, the ability to just think about, you say, I want a video of a unicorn flying through a rainstorm. How all the work you used to have to do to create that, from the programming, or do you want to create a unicorn and run it through the rain and have a cameraman? Now you can generate that. So I think it's going to make those marketing content creation costs fall dramatically. And that could benefit all companies, because all companies advertise in some form. Right. So I think those are some of the areas I think you'll start to see it coming through, outside of just the semiconductor sales numbers.
Katy, what names are you, or even if not names, what sectors, you get as specific and descriptive as you might possibly like to on the topic?
Yeah, I mean, I can agree with, all of what Shanti said there. I think, some of these companies just have great earnings, so we don't want to bet against them. But, there are risks to people copying what they do. In terms of uses, we've been looking quite a lot at healthcare, for example, is an area that can use a lot of these technologies, whether that's through sort of drug development or just other ways to help screen and diagnose patients. And obviously you've got a big longevity angle there. But whether this is something that comes through immediately or it's just a very, very long-term issue is, it's really hard to pinpoint that, I think. So yeah, but the uses are obviously very, very broad for these tech across sectors. It might come down to it's really name specific rather than sector specific. And again, that's one that I really think the active managers are there to, that's the role, and that's them, doing what they're expected to do.
And I guess the 24-hour news cycle can either work for or against you in that.
Well, completely, yeah, completely.
I'm not quite sure how that works exactly.
The week, the month, or you can, or not. But we've got, from our perspective, we've got to be reasonably long term in our thinking around that.
You're not looking for like highly tactical moves around.
We're not looking for highly tactical moves, but where we do think there's value, and whether it's today or over the next sort of 5 to 10 years, is in some of these mega trends. Whether you're looking at the demographics, whether you're looking at sort of emerging global wealth, and obviously tech is one of these mega trends that we should be looking at. But it's tech, demographic, and social change, but they're all interlinked. So there's a lot to get excited about in this space.
Megatrends. You're talking Sylvia's language there. I can see her lighting up. So I will 100% let Sylvia.
Nice segue.
A very nice segue. Yeah. Thank you so much, Katy. You would think we would have planned that. So Sylvia, I'm going to have you lean in. I mean, megatrends. That's at the core of what you guys do. So interested to hear where you're leaning right now and where your focus is.
Yeah, and so I think both Katy and Shanti made all of the points that we think about, and kind of like those points are the reasons why we construct our funds the way we do. So the first point is that fully agree that all of this AI hype has to translate into other sectors, right? So we're now interested in things like if you listen to the company earnings now, right? Everybody's trying to sprinkle in the word AI to get some extra coverage or whatnot. But if you think about, the big weight loss fad, for example, with Lilly and Novo and all the different Ozempics and injections and things like that. Well, a lot of the CEOs are talking about, well, the next, gen of that could be oral, right? It could be a pill instead of a shot. But if you just think about the drug industry, health industry in general, you have, loads of research that sit in these huge data centers in the middle of, the country that are, kind of unparsed data that takes many hours for physicians to access so that they could further their research. So with AI and supercomputing, that becomes more efficient, and that, obviously that's the positive side of AI, right? Information that could help the world and help cure diseases and things like this, and it's also monetizable. Aerospace and defense, IBM is working on a project in Korea, for example, to have more precise missile targeting and things like this. So it's something that could perhaps improve or better kind of military logistics for different countries. Driverless cars, electric vehicles, smart cities, everything kind of depends on AI working. And to the point of like the megatrends and how do you actually broaden that out? So it's not just NVIDIA. They're definitely, kind of the shining star right now, and AMD. So you have your top semiconductor companies, of course, but what else do you need? You need cloud computing, right? And so companies like Microsoft, Amazon, Google, they can benefit from this trend too. Copilot was mentioned too as another AI type of play through Microsoft, but you need cybersecurity, right? So the Palo Altos of the world, you need cooling for these huge computers to run. So you have like Form and Supermicro and companies like that. I just think that there's going to be, like, if you look through all of the sectors that are relevant to this, whether it's kind of like connectivity, low latency communications, it's the 5G, 6G, it's cybersecurity, it's cloud. So yeah, I mean, we're very much focused on making sure that our funds give access to the top names in those spaces that we think are actually going to be, the beneficiaries of the AI trend. And totally the point that was made about this broadening out to other companies like this, I think, this is an exciting year for biotech and healthcare, right? It's a trade that's been dead for a long time. And I was always like, you have to have some of that in your portfolio. They pay good dividends, aging baby boomer population, post-COVID, everybody's back having their medical stuff done, surgeries, and like, womp womp, like nothing has happened for so long. And here we are with these weight loss drugs. And that's now also shining the light on other things that they do and drug development, like whether it's diabetes, metabolic diseases, cancer, things like this. And so I do think that industry is going to kind of come out as one of the winners of AI.
I think it's interesting you raised that. Something that we've had on our radar actually in 2024 is, I mean, AI, and we're calling AI and AI adjacent, right? Like we're watching cybersecurity, 5G, semiconductors, all that quite closely, because we do think that there's really valuable tailwinds forming there. But the other thing is around this, we're innovative health type themes, potentially off the whiplash, off the fact that they've not had a fantastic run of late. But there are some interesting, you look at genomics, and we have a novel neuromental health that's like around deep brain stimulation with non-opioid pain, and as well as even what we've got moving in the pharmaceutical side with related to psychedelics and cannabinoids and stuff like that, right? They're longer term innovation. I know that Shanti, we had this conversation the other day a little bit around the healthcare space. I think that you like this, like, the bigger players in health, not so much the small caps, if I'm remembering correctly, but like I think
I mean, I'm sure there's people that are going to pick small caps, but no, it's not us. We do in one of our portfolios we do have some themes funds that do like healthcare investing, and I think the point is not just about broadening it to think beyond pharmaceuticals and think about health in general, because then you get into some of there's big health insurers, there's companies that do therapeutics, there's the medical devices side of it, and then you do have pharma. I think some of it was, we had kind of a high of earnings from some of the COVID vaccines, and then those kind of fell out, and then now we're sort of trying to find a new, what's the next new thing, and a lot of that stuff does look promising. The other thing I forgot to mention on big AI beneficiaries, which is probably one of the biggest, and I thought I'd throw it in, is computer programming is getting cheaper. So I think you saw this huge rise in developer salaries, and basically what developers could get out of technology companies. There's all these like coding predictor tools and coding buddies and code checker stuff that dramatically increases the time to code. And I think that it's gonna help those big technology companies, but everyone that employs coders, because a single programmer is gonna be able to do more, and potentially you can employ fewer of them. And it's also probably going to drive down some salaries in that part of the industry, which then is helpful for company margins, because everyone, nearly every sector, needs that service these days. So I think that's the other way that you can see AI probably more help the tech sector, but will help other sectors in the long run.
So Shanti, you're raising something, specifically around those salaries, that it brings me to the other topic topic that I can't remember which one. Somebody mentioned the potential of a tech bubble, and I think we were all around. We all saw our angles of the tech bubble, and then also, I mean, it was very recent where we saw this like tech flurry at the back of 2020 and into 2021. I'm going to move now to sort of talk this public equity space versus the private markets. And there's been a huge reckoning in the private markets, obviously through 2023. And did it actually go live yet? I think today Reddit IPO'd. So one of the few IPOs that we've seen. I'm watching the screen live here off of my corner of my eye. Can't quite make out if it did or not. And there's been this lull of IPOs, but everything that I'm hearing from you guys, I mean, naturally, there's still some more traditional pockets that you're looking at. Like, there's still a lot of focus on innovation and the next thing to come and the value that brings to the market. So I'm interested to hear kind of one, Katy, I'm going to go to you first on this. Like, how much from your seat do you guys look at the private markets? How much of a role do private markets play in what you're doing, or not at all?
Yeah, so I mean, private markets, it's something we've long been proponents of at North Capital. Our clients, definitely have an interest in this space. There's definitely return benefits. And if you've got the long-term perspective, there's some really exciting investments. Also adds, a lot of diversification benefits, relative to what your core portfolio might be doing. So that's, particularly useful. Access can obviously be tricky. So we actually work with a really good provider to help us with that for our clients. But it's something that we've long been doing here at North Capital. So yeah, we think it's got a very valid place in investing.
I think I find it. I mean, I'm biased. We often look at the intersection of public and private because I live in the world of thematics, and we have to in order to try to figure out, exactly where the dynamics and innovation is going. But I was talking to some hedge fund, I was at a hedge fund event the other day, a couple weeks ago, and what I think was one of the most refreshing things to hear is, 2021, it's a pretty tough vintage year to have in your portfolio, but 2024 really, like, it could be a fantastic vintage to have when it comes to the private market space, potentially, just because of the reckoning that did come through in 2023. I'm gonna Shanti, Sylvia, interested in your perspective on this. Like Sylvia, on your side, you live in thematics. I mean, a lull in IPOs, I imagine, has some knock-on effect to the work that you do. Shanti, interested to hear, how you look at private markets, if you do, or just in general, how you're looking at, where we were not too long ago versus where we are today, and how we should be looking at that from a public equity space or not. Shanti, maybe first on that.
Sure. Yeah, so we do within M&G, a lot of our multi-asset stuff where you can hold it. We do private assets. We have things we offer that need daily liquidity, so you just can't. But we still do have that liquidity premium. I think a lot of what we saw in 2023 was just private assets catching up to 2022, because there's always this lag where, it takes time for buyers and sellers to agree on prices, whereas in the equity market, you have to agree instantly on the price. But you still do see that liquidity premium. I think, obviously there's less tolerance for those kind of speculative business models where there aren't any revenues yet. So I think higher interest rates force a lot more discipline on capital markets and private businesses. You need a clearer path to profitability to be able to, to get investment or to go on to the public markets. And I don't think we should be relaxing standards about who gets to list. It's great we kept all the SPACs out of the UK, because it would have actually crippled the FTSE 100 if we would have let some of that crap into our market. Some of those companies have already gone bankrupt, in the space of a year or two. So I think keep listing standards where they are. Investors, keep your standards about how is this company going to increase my capital and return it to me. And that, I think, it forces good discipline on the market.
Not worried about the shrinking public equities market, or
not
if it's quality, it's cool. It's
there's I think if you do private stuff, you can, there are more private companies than there are public companies. But at the same time, not everyone will sell to you on a given day. Whereas, public markets, you do have that fantastic ability to invest all over the world. So I think we still do have a pretty good breadth of what you
Okay.
can do. So
Sylvia, I noticed you did give a chuckle on the SPACs. So I'm not going to let you off. I'm gonna ask for what you were thinking around the SPACs.
Shanti's right. I have a lot of unique experience with this because we tried to run a SPAC fund, and so a lot of it didn't play out so well. I think part of it was like, if you look back to 2020, there was so much coming to market, and everyone wanted a piece of it because it was the new and exciting thing. And then a lot of deals just kind of like didn't happen. A lot of the companies, weren't valuable. There wasn't a great investment prospect on it, and it was just such an interesting type of experience to have in the US market, just to see how these well-funded deals by, whether it was celebrities or the biggest hedge fund managers out there, just flopped, I mean, for lack of better words. And so I think that now, and it's interesting because I've also worked on an IPO fund, which was actually just, kind of true IPO come to market fund. And even those have their issues, like where the processes are there and the due diligence is there. And there's this whole kind of like, quick price run up and then the stock price. There are certain behaviors that happen when IPOs go to market, and longer term, those funds were always tricky to run too. And so I think that, we look at it a little bit differently now. Like we'll look at something like Reddit, right? And Reddit claims to be an AI company. We're obviously very interested in AI. So now I think what we're going to wait and see is how much of their revenues are they actually going to generate from AI? Are they going to have AI? Or is it just going to be a meme stock, right? Like the hype around Reddit. And I think that there's something there, right? With a company like that has this hundreds of millions of TAM and whatnot. But yeah, I mean, I agree with Shanti. I just think the standards are so much higher for what people are willing to invest in after having seen what happened with SPACs. And IPOs are more thoughtful, in my opinion.
I mean, those learnings to me are great, right? Like
to
me, that just
sure.
screams like you're coming from a position of strength, right? And that hopefully at the end of the day leads on to just better strength and quality of market probably in 5 years. So as opposed to sort of I'm going to find the silver lining here, that it's supposed to look into the lull of IPOs as potentially some innovation stagnation, but rather it's just some valuable rationalization here. Like let's really make sure that the company is ready, and that the public equity space is the right place for the company at the point at which it comes. So I think that's interesting. I mean, well, you guys are bringing it's very positive. I'm feeling a little bit uplifted on this Thursday morning or Thursday afternoon for Katy and Shanti here, which is always nice to hear. But worries, right? I mean, we talked a little bit at the front. Okay, what if although it didn't sound like actually you're that worried about it, that even if people are expecting it, that if we don't get the rate reversal as quickly as possible, I'd be interested to hear from you guys, like anything that is creeping in the back, someplace that you think is a little too hot out there, or and if there's none, I take that as well. I'm happy to, head off on the day feeling really, really great about where we're headed. But Katy, do you have anything that you are really watching?
I mean, I guess we're watching central banks closely. I think that's really important. But it's really interesting there, because I think what we're seeing is they're saying, well, even if inflation's at 3.5, whatever, they still expect to cut rates, 3 times this year. And in the case of the US, for example, which obviously dominates markets, if we do see a change, any significant change in the rhetoric, I think we really have to stand up and take notice. Aside from that, I kind of think economic cycles tend to move quite slowly, and therefore we're just in the midst of this one and we don't need to worry too much aside from that, but that's what we're watching closely.
Okay. Shanti?
I feel like there's nothing keeps me up at night, I would say. We always have things going wrong in the world, and we'll continue to. I think with a lot of the elections we have, I think we're going to keep seeing governments going in an opposite direction to central banks. So government is going to be spending lots of money, and central banks are going to be trying to tighten. And so I think there's going to be that fundamental tension that creates some distortions in the economy. I think the real genuine risk for the world is China invading Taiwan. That would create, that would take a huge amount of like semiconductor capacity out of the world, which would impact Apple and all the big technology companies, not to say the economic and trade damage that would occur. I don't think it's something that's likely, but it's certainly something that's possible. So that's something I do think about. And then I think it's just, it's just general, can we keep growth up? Can we keep earnings up? Can companies continue to navigate so many different issues, which they've done, but as the world gets more and more complex, there's more and more risks that we can't adapt to things quick enough to deal with issues, whether it's a government adapting or a company. And I think like that's the kind of existential danger. The world gets so complex, we struggle to adapt. And there's also things like you look at, the US, you can get rid of, you can change your staff profile in 2 weeks. In Europe, it's 2 years. Is Europe going to struggle more to adapt than the US just because they can't change their corporate profile and cost structure as quickly as other places can? And I think that speed of adoption is going to get more and more important as you have to keep changing and evolving if you're going to run a successful business.
Yeah, I think that emphasis on nimbleness is very interesting. The one I'm going to move to a client question, or to a caller. I don't know, viewer. I feel like calling them a caller feels not quite appropriate. But Shanti, because you did mention China there, do you think that it's in recession despite the official numbers? Do you have any concerns? I mean, I know you mentioned at the get-go that you weren't really looking at China as a place to look right now, but are the concerns that deep, or?
I don't think it's. I think they need to get more to like an internally generated growth model, because they're not going to get the same level of foreign capital that they used to be getting in the future. It's fallen because of all the political and export restrictions action have been taken. So they're going to have to generate more of their own growth, and that path takes time. I doubt they're kind of in a actual recession. Are the numbers as strong as 5%? It's, no one will ever know. And even you look at our own GDP numbers, we never really know what the number is. As much as we might publish something, it gets changed. So I suspect China is growing. And they'll also rebound a bit, just as goods rebound. I think some of their weakness was just the fact that, we stopped buying so much stuff and started going to more concerts and eating out. And that had a knock on with exports. So to some degree that wasn't their fault or, downcoming as a market. It's just they do goods, and goods are in less demand. So as we see some of that rebound, that could also support the numbers a bit more.
And it hasn't come up at all yet, but I will put it out there because we are getting a question here. Anybody have any views on Turkey?
Not particularly. I mean, I think still a bit of way to go to rebuild credibility as a central bank and economic management. It's not a market I spend a lot of time looking at. Very geopolitically important, of course. But yeah, maybe, I don't know, Katy, you've come up, maybe you have a view, but I don't have a particularly strong view on it.
I mean, I don't have a strong view on this either. It's not an area, again, I spend much time on, but from a high level perspective, I would say that, even if you did find a company or a sector, what have you, that you thought was great in Turkey, you can't get away from the currency risk. And back to Shanti's point about the central bank and the economic management. And that, I think, makes it, almost uninvestable until you see, a greater period of stability to give you that comfort, because it's difficult to get over, to build a strong case where you're not worried about that. There's so many other opportunities in the world, is how I would put it. That your attention,
why there. And Sylvia, I'm not forgetting about you. Biggest worry, if you have them.
Yeah, I mean, there's always like geopolitics, right? China, Taiwan would be a huge issue, and particularly for us because we are so, kind of centric to tech and AI and future innovations. I mean, we have other, things in the hopper, obviously, but that would matter. And the election, kind of the election result and the relationship between the US and China will matter. But Yeah, I think, we feel pretty good about this market. We think that corporations have been able to deal with inflation. Now they're going to have less of it. And we wonder, if that does help markets overall, if it expands breadth into small caps and, kind of helps various sectors beyond just tech. So we think it does, and we think it will be, kind of a good year off of that. But, this market is so interesting now. It's investors react to certain pieces of news that aren't meaningful, and don't react to pieces of news that are meaningful, and the entire market shifts quickly. And so we're always just kind of, on our toes, watching what's going on. But I think that, for our side, our message to our investors anyway is always that, like, dollar cost average, long-term hold, think about things for the long term. Don't kind of worry about this internal noise, and try not to chase too many bubbles, and we'll be okay.
Well, I think that's actually a beautiful way to end the conversation. I think it actually encapsulates the idea that, from all three of you are hearing this idea of, leaning even further on the growth side from where you were at the beginning of the year. And most importantly, I think through the conversation today, we just really heard from you how closely you're looking at the market, and that you do find the opportunities, but it's going to take a little bit more of an active approach. And there really is some opportunity to shine off that. So those are fantastic, clear takeaways off the conversation. I will also, therefore, thank you, Sylvia. I forgot that part. Sylvia, Katy, and Shanti for joining me today. I'm also going to remind everybody that's dialed in that Evenco's next fund forum will be held in London on April 18th. So you can look out for that either via LinkedIn or any of Evenco's portals in order to find out more information about that. It was an absolute privilege. It's not often I feel like I get to moderate a few things. It's not often I get a panel of this caliber, although every panel is wonderful in one way or another. So I really do appreciate the three of you joining me for such a good chunk of time. It was a great conversation, and we'll stay in touch.
Great. Thank you very much.